will then explain our assessment of financial monetary conditions. Looking at the economic activity, the economy has been resilient. It grew by 0.3% in the third quarter, mainly reflecting stronger consumption and investment. Exports also increased, with a significant contribution from chemicals. The sectoral composition of growth was dominated by services, especially in the information and communication sector, while activity in industry and construction remained flat. The pattern of services-led growth is likely to continue in the near term. The economy is benefiting from a robust labor market. Unemployment at 6.4% in October is close to its historical low, and employment grew by 0.2% in the third quarter. At the same time, labor demand cooled further, with the job vacancy rate at its lowest level since the pandemic. The staff projections see domestic demand as the main engine of growth in the years ahead. Real incomes are set to rise further, and the saving rate should gradually come down from its still high level, supporting consumption. Business investment and substantial government spending on infrastructure and defense should increasingly underpin the economy. However, the challenging environment for global trade is likely to remain a drag on growth in the euro area this year and next. The Governing Council stresses the urgent need to strengthen the euro area and its economy in the present geopolitical context. We welcome the European Commission's call for governments to prioritize sustainable public finance, strategic investment, and growth-enhancing structural reforms. Unlocking the full potential of the single market is crucial. It is also vital to foster further capital market integration by completing the Savings and Investments Union and the Banking Union to an ambitious timetable, and to rapidly adopt the regulation on the establishment of the digital euro. Looking now at inflation. Annual inflation has been in a narrow range since the spring and remained at 2.1% in November. Energy prices were 0.5% lower than a year ago, after a larger decline in October. Food price inflation was 2.4% after 2.5% in October and 3% in September. Inflation excluding energy and food was steady at 2.4%, as goods and services inflation moved in opposite directions. Goods inflation declined to 0.5% in November, from 0.6% in October and 0.8% in September. Services inflation rose to 3.4% in October and 3.5% in November, from a 3.2% in September. Indicators of underlying inflation have changed little over the recent months and remain consistent with our 2% medium-term target. While growth in unit profits was unchanged in the third quarter, unit labor costs grew at a slightly higher rate than in the second quarter. Compensation per employee rose at an annual rate of 4%. This was more than expected in the September staff projections and was due to payments over and above negotiated wages. Forward-looking indicators such as the ECB wage tracker and surveys on wage expectations suggest that wage growth will ease in the coming quarters before stabilizing somewhat below 3% towards the end of 2026. Inflation should decline in the near term, mostly because past energy price rises will drop out of the annual rates. Staff expects it to stay below 2% on average in 26 and 27, with energy inflation negative over most of this period, and inflation excluding energy gradually declining. Inflation should then return to target in 28 amid a strong rise in energy inflation. This, in part, reflects the upward effect on inflation of the EU emissions trading system 2, which is now expected to